oftentimes in crypto, there's a lack of maturity in the underlying market. What that means is low liquidity, low trade volumes. And so these assets are very, very prone to aggressive price appreciation or depreciation, even with a small amount of buying or selling pressure. That lack of market maturity and general illiquidity that plagues the crypto market is a cause of this decoupling of price versus value.
Shane Molidor is the founder and CEO of Forged, an investment bank and advisory platform that wants to bring transparency and efficiency to token launches. Forged works with blockchain projects and market participants to design sustainable token economies, improve liquidity, and create fairer trading environments.
I would estimate about 70% of all tokens
70%
are victim to what I call the predatory and parasitic market-making engagement. I think it's an unfair playing field because it's very nuanced aspects of capital markets and market microstructure to understand why a market maker might be willing to engage in that sort of arrangement with a project. And then nuanced aspects of these engagements that could potentially impact token price post TGE. Founders just aren't privy to it. They only get one shot at this, whereas market makers do this for a living. And so to navigate at the same level as a market maker is very difficult for a lot of these blockchain founders.
Today's guest is Shane Molidor, the CEO of Forged. Forged is an investment bank and advisory platform that provides essential tooling for blockchain projects. Shane, I also know that you have led a number of roles at prominent crypto exchanges, trading desks, investment firms across US, China, and Singapore. Now you're back in the US, right? So what made you want to go from that world, literally, to being an operator in this world?
Sure. I guess at the highest level, I was sick and tired of seeing projects with strong fundamentals lose the game to essential operators like exchanges and market makers because they didn't understand the nuances of go-to-market. So now aligning with blockchain projects, it's all about providing the advisory as well as the essential tools and software to help them navigate that more effectively, from things like designing effective tokenomics, engaging market makers in a synergistic capacity, listing on the right exchanges, maximizing value, liquidity and launch underwriting, and then all post-TGE optimization. So really giving power back to the projects is what led me to found Forged.
I mean, that's a fair reason, a bunch of fair reasons. And I feel like the crypto market today, there's like, sure, it's like back to near all-time highs for market caps. Like I think it's like 3.5 trillion, 3.8 trillion. And we're seeing institutions coming in. So in general, it's maturing. But when you kind of look under the hood, it's still chaotic. The token launches, the inconsistent metrics, the hype driven behind a lot of these tokens, right? I see it like day in and day out. I know you've referred to it as a signal to noise problem, right? What do you mean by that?
Yeah. So I think in this new market cycle, we're measuring things based on like the loudest meme rather than the strongest fundamentals.
The best meme.
Yeah. And like there's so much churn in the space that like that goalpost is always moving. And I think that like there's a lot of froth and excitement there as like Web3 is this like ultimate decentralized casino. But sometimes I think that we're missing the beat in terms of like strong fundamentals and projects that like really have potential to revolutionize really the world as we know it. So I think there's a lot of noise and there's a lot new access to like the next high flying asset, especially with the advent of like these new launchpad platforms like Pump.Fun. But I think sometimes like we miss like the real signal, which is like strong fundamentals with true potential amidst all of that froth.
Right. And then when it becomes less frothy, then does it kind of like bubble up to the surface?
Yeah, I mean, it's yet to be seen if like it will become less frothy now that like retail has this unrestricted exposure to high potential assets, and like launch pads are like the new meta on chain launches. So I think cycles ebb and flow. Like we'll probably see meme coins die down soon. I don't know if they'll die like the ultimate death like the NFT craze did.
Yeah.
But I think these days it's much easier to launch a meme coin, something with no fundamentals, that's value is purely speculative. But it's much harder to launch a token with like proper utility and fundamentals, because in order to do that effectively, you have to kind of compete with all of the froth and the noise, because at the end of the day, like that speculative demand is really important. It can make or break the success of a new launch of something with true fundamentals. And like it's difficult to capture the hearts and minds of retail given all of that noise.
Yeah, I will get into the token side of things with you a bit more in a minute, because like I think kind of like fundamentals versus like the hype and the fun of like cute dog image is definitely something we could talk about. But I want to start at like a high level overview on like, how do you kind of view the state of crypto markets today? How would you characterize it? Do you feel good about it? Price included, sure, but like as a general look at it.
Sure. Sometimes like people respond to this question, they're like, oh, we're in the early innings. Like I like to think of it as like level of maturity. And I think like teenage years, like tons of potential, like really bad hygiene, like lots of noise, but like lots of potential. So teenage years is what I see. And I think like how we continue to mature is more transparency to the investing public. I think that becomes even more relevant now that we do see the institutionalization of crypto. We see real institutions getting spot exposure, you know, whether it's through digital asset treasuries or actually getting, you know, proper spot exposure from a centralized exchange or ETFs and whatnot. So the institutional wave is here. They need more transparency so that they can make informed investing decisions. And retail deserves those same sort of disclosures as well. And there's still a lot of skeletons in the closet for Web3 launches. So yeah, teenage years, lots of potential, poor hygiene, still lots of noise.
And when you talk to these investors, they tell you that they're like, hey, we don't really know what's going on. You're going to have to show us, explain it to us, or like something needs to change.
Yeah, I mean, look, I've been professionally active in the space since 2015. And like when I first started, like it was one of the first hires at Gemini working with the Winklevoss twins. So back then, like 10 years ago, the institutional wave meant something much different than it does now. I think back then it was like, are institutions going to take Bitcoin seriously? And like that much has been made very, very clear. And so now we get institutional interest in like the longer tail of assets. And that's where I think that there's still a severe lack of hygiene, a lot of noise, a lot of obfuscation. I don't think price equates to value for a lot of these assets. I think that there's like an illiquidity crisis. So yeah, I think institutions, especially like liquid funds, oftentimes are coming, speaking with me and the Forge team about like, you know, tell us where the skeletons are buried, that sort of thing. Like, what are the things to look out for? And most importantly, like aren't really taking assets seriously unless they achieve a sufficient level of global liquidity. And that means like top tier exchange listings, adequate depth, tight spreads, that sort of thing.
What do you think kind of got us here in the analogy of the teenager, right? Obviously, like we're growing up, but we're still in this like shaky period where you've mentioned there's like the bad hygiene and like the things going on behind closed doors and just like the lack of transparency, right? Do you think that's like an industry problem, or this is something that came from just being early? That's a polite way to put it.
It's a good question. I think ambiguity and potential brought us here. Like regulatory ambiguity and unlimited potential brought us here. Like we looked at TradFi equivalents, like they had decades to iron out like disclosures, regulations, compliant means to go public. You know, if you're a private company and looking to make that transition from the primary market to the secondary market, like it's a very well-defined process. There's clear guidelines to navigate, and there are established players that can help companies through that process. In Web3, there's regulatory ambiguity. There's unlimited upside potential in terms of creation of generational wealth, even for very immature early stage companies. And there's a lack of clearly defined institutions to guide projects on that path. And so whereas TradFi had decades to iron out this process with a relatively small number of companies making that journey, crypto sort of flipped it on its head that like there are thousands of launches that are occurring now every day with a lack of clarity. And it's sort of like, we'll figure it out later, and that'll be a forcing factor.
Right.
So I think that's led us to poor hygiene and lots of noise.
Yeah. But I mean, now we're kind of getting that regulatory clarity, right? Or at least the conversations of it. We have the Genius Act passed in the U.S. and then, you know, there's market structure, the Clarity Act, literally clarity. So hopefully that kind of provides a bit more structure and seriousness.
Yeah.
That kind of like your mindset.
Yeah, I think what's most important, so there are two things that are really important. I think the regulatory classification of assets, as well as clarity around where token issuing entities can actually call home. So regulatory status of assets, like every major exchange or market maker will require an asset to submit a legal opinion that establishes the token as a commodity or utility token and not a security. I think the reality is most assets start their life cycle heavily centralized with the efforts of a core team being directly aligned to their success or lack thereof, which if you use a traditional Howey test means that they are a security. But then they are sort of in the pursuit of gradual decentralization. I think that there needs to be clear frameworks around how to pursue that decentralization the right way with an acknowledgement that at the earliest point of their life cycle, these assets are probably securities.
Yeah.
And then the second area that I think needs further clarification from regulatory bodies is, you know, right now, a majority of teams that launch a token have a labs entity, and that comprises their core contributors based in the US, but they'll go offshore to create a foundation or association. That foundation or association will be the legal entity that issues the token and operates as a nonprofit and oversees that gradual pursuit of decentralization. Like there's this whole cottage industry of service providers that help founding teams create that entity and staff it with lawyers and directors. And it's just leaking value from the US, but there's no clarity around actually having a token issuing entity based in the US. So I've found most projects are too scared to pursue it because they know it could be a blocker for them to achieve a listing on Binance or Coinbase or work with a top tier market maker. So there just needs to be more regulatory clarity around the right way to do things.
So you're saying these foundations are too afraid to make roots in the US currently still?
Yeah, I mean, it's just
I mean, I see it. Yeah, I'm just also trying to like make sense of it.
They view it as a necessary cost. It's like, well, okay, I'm calling the shots from my lab entity. I'll spin up an offshore entity, either island jurisdiction or maybe like in Switzerland. And I'll pay anywhere from $50,000 to $250,000 in order to do that, just so that I don't have a potential blocker when it comes time to list my token on a centralized exchange or work with a market maker.
Do you have an opinion on it? Like where it's just kind of like how things have been done and it's a reality of like what needed to be done? Or do you think it's not the best?
I mean, I think it's kind of BS because...
So it's not the best.
Yeah, I mean, basically the trail that these projects try to lead is that the token issuing entity is independent and totally distinct from the core contributors that are operating labs. But if all the decisions are being made and the success of the business, product, and protocol are driven by the core contributors, then this is just a shell entity that was created due to a lack of regulatory clarity. And it's just a waste of capital. It's leakage of talent and capital that could have been planted in the US. But again, I've found that core contributors and founding teams are scared of the ambiguity and don't necessarily want to be a guinea pig that's blocked in their go-to-market strategy when it comes time to list with an exchange or work with a market maker.
Yeah, that's a good point. When you talk to these investors too, do they share the same sentiment? Because like in public markets, it's like, oh, the stock was issued by the company. And we all like make sense of it and we move on. But meanwhile, in crypto, it's like, who issued this token? You know?
I mean, I think those that know that like
if you know, you know.
There are core contributors that are dictating the success or the lack thereof. And like, a liquid fund is contemplating an investment in asset that's trading well. They want to interact with the team. They're not discussing with the directors of the foundation, some lawyer that, gets to cut a paycheck every month to just, have a seat on the board. They're discussing with the core contributors that are part of the labs entity and actually driving growth and innovation within that issuing entity's native token.
Right. It's different. Yeah. Something else you talked about before, and I was like, we'll go back to that, is like, obviously there are thousands of token launches happening every year, maybe even every week, depending on the time of the season. And you said that token price doesn't always equate to intrinsic value, and that the price of a cryptocurrency often reflects the momentum and not so much fundamentals. And I see this like day in and day out. I work with a lot of projects that have a lot of utility, and they could announce the best things for the project, and it still really won't move the price. Whereas like a little Doge type image, I don't want to like start saying specific tokens, they do whatever. They could like literally post a photo and it'll go viral, and then suddenly it's like the hottest token right now. And sure, these things don't always last, especially on the meme coin front, so I don't think it's like fair to say that they're the same. But like, can you kind of unpack what you mean versus like momentum versus intrinsic value, and how do you kind of think about that?
Sure. Yeah, in TradFi, I think to a certain extent, prices equate to fair value, and that's due to transparency on underlying fundamentals. It's a publicly traded company. There are mandated requirements and disclosures that you need to make. Those disclosures are then sort of interpreted by the talking heads and analysts, and then their insights and key takeaways are disseminated to the investing public, and that catalyzes buying or selling decisions. So you align, valuations and price as an extension with underlying fundamentals. As fundamentals evolve, prices reflect that. As they deteriorate, prices drop to reflect that accordingly. You can have bouts of what's called transitory volatility, where there's such a wave of buying or selling that prices and value or fair value dislocate, but largely speaking, then they would converge. Obviously, with like COVID, we all learned about like the meme stonks and everything. We have these massive decouplings of price versus fair value on equities that I don't think that the valuation is truly justified. But I think that those are largely outliers rather than the norm. In crypto, there's a lack of transparency on underlying fundamentals. Oftentimes there's a lack of fundamentals. There's no price to earnings ratios or free cash flow or anything that we use as proxies to determine what fair value is. But I think most importantly, oftentimes in crypto, there's a lack of maturity in the underlying market. What that means is low liquidity, low trade volumes. And so these assets are very, very prone to aggressive price appreciation or depreciation, even with a small amount of buying or selling pressure. And so oftentimes what you'll see is illiquid assets will, have some sort of wave of buying or selling that comes in. Let's say aggressive buyers. As a consequence of these aggressive buyers, even a small amount of capital injected, they appreciate the price aggressively. From the sidelines, people see that asset is going viral just based on that price appreciation. And it's top of the charts for CoinMarketCap, CoinGecko. It's on the leaderboard of all of the exchanges. And they say, oh, something good must be happening. And they start buying as well. And the consequence of their buying into thin liquidity is further price appreciation. You just see, a token absolutely take off, even though nothing has really changed from its underlying fundamentals. And the inverse also holds true, is that, maybe an asset has no material change to its underlying fundamentals, but a large token holder chooses to like take profit. Thin liquidity, as a consequence of that selling, price starts cratering. People, from the sidelines say like devs are rugging and they start selling in a panic as well. And then you get price capitulation in the opposite direction. And again, now you have price that doesn't equate to fair value just due to a lack of liquidity. And I think that lack of market maturity and general illiquidity that plagues the crypto market is a cause of this decoupling of price versus value.
So how do we fix that?
I think that there need to be higher standards on what it means to actually launch a token. I think that the gatekeeping that occurs in TradFi, that means, if you are to go public, it's quite expensive to do so. Generally speaking, it, aligns with more mature companies that have more capital that can afford to do what's necessary in order to ensure that there is a relatively mature secondary market and that preserves general user experience. It means that there's a limited number of investment opportunities versus Web3, which has, again, thousands on a regular basis. But again, I think that it protects the end user, the end investor, whether they're retail or institutional. I think that's part of it. I also think essential disclosures need to be mandated for crypto launches. I'm not talking about meme coins. I'm talking about Web3 launches that have proper fundamentals, a true cap table, token utility mechanisms, proper...
Does that not exist for most of them today?
Well, I mean, if you look at meme coins,
Well, not the meme coins, yeah.
yeah, meme coins, I mean, they don't... What is the demand? It's speculative.
That's all you see on DEX screeners. Yeah. That's all the metrics, the demand, the fundamentals are there.
Exactly.
And it's nothing.
That's the froth. That's the noise. But there's still real companies that are trying to issue tokens with real utility and underlying fundamentals. So I think proper disclosures for those types of launches, not just on tokenomics, like the supply and demand, but also other essential alignments that they have for their go-to-market. So the nature of market-making engagements, which can frankly make or break a launch. The nature of exchange listing agreements, what fees are paid, what is the vesting schedule associated with the tokens, transparency on opening valuation and the liquidity that exists at that opening valuation, and then any other private dealing that could influence token price. So, backroom allocations to KOLs and whatnot. I think all of those different types of disclosures need to become more commonplace in order to better inform the investing public.
If you've been listening to this podcast for a while, you know that every token launch is high stakes, but Forged helps projects get it right. Thousands of Web3 projects leverage Forge's free tools to design smarter tokenomics, engage market makers on fair terms, plan listings strategically, and monitor liquidity after launch. Start using the Forge platform for free or sign up for white glove advisory services at forgd.com. So when a trader or someone sees a token doubling, what are they actually seeing? Is it just someone putting a lot of money in, like a whale? Is it adoption, market choreography, right? And then to your point about transparency, like what will it take for the crypto market to be more transparent, go back to these fundamentals opposed to just like hype-driven price action?
Sure. So token price doubles. I mean, what are you saying? More buyers than sellers, right?
Perhaps, or big buyer.
You're seeing aggressive buyers interact with patient sellers, and in the pursuit of liquidity, they appreciate the price. What does that actually mean? So it could be a reflection of evolving fundamentals. It could be a reflection of transitory volatility. Whether or not you should actually put weight in the price doubling, I think requires further analysis. So you need to look into what was the volume that was conducted there. If there's low volume, we would consider that what we call weak price discovery. If there's high volume, it's efficient price discovery, right? Any sort of change in price, and crypto markets are open 24/7, so we call it continuous price discovery. Price discovery is fancy way of saying like a debate between buyers and sellers, bulls and bears, and the goal of that debate is to determine what is the fair value of this asset. Right. Now, if we were going to host a debate about any topic, we would want to be sure to involve as many people representing as many diverse opinions as possible. So the conclusion of that debate could be perceived by the rest of the world as a fair reflection of, everyone's opinions were being held. If we only involved a small amount of people in that debate, the conclusion of that debate, whatever conclusion we achieved, probably wouldn't be respected by other onlookers as a fair representation of how they might actually view the world. So when you get high volumes, means efficient price discovery, because a lot of people were involved in that debate. And so if I saw price doubling on high volumes, I actually think there might be staying power here. If price doubles on low volume, I might think that price appreciation was just a function of poor liquidity. It's a thinly traded market. Therefore, price could keep going up, but it not a lot of people are involved in that debate.
Yeah.
Or just as likely, it's going to drop back down
Mhm.
because, again, it has no business being double what it was a moment ago because not a lot of people agree with that price
Yeah.
reflecting the fair value.
How do you define low liquidity? Does it depend on the asset, or is there like a certain marker where you're like, there's not much going on here?
Yeah, I mean, you can measure liquidity based on the depth. So what is the magnitude of patient buy and sell orders? The tightness of liquidity. So the distance between the most willing patient buyer and the most willing patient seller. So the best bid and the best ask, as well as the resilience of that liquidity. So how fast does it replenish once it's executed against? The best way to view liquidity is just a function of market capitalization, right? So what's the circulating token supply multiplied by the price? That's the market capitalization. And then compare that market capitalization to the US dollar value of aggregated patient buyers and patient sellers.
Yeah.
Right. So of the tokens that are in circulation, how many are people actually placing as bids and asks at any point in time? Right. And that's the way to compare apples to oranges. If you really want to simplify it, it's like, can I get $100,000 order done without significantly moving the price? Right. If I'm appreciating the price or depreciating the price by multiple percentages when doing a trade of that size, it's an illiquid.
It's low liquid.
Yeah.
It's like a masterclass in all of this information. Do you think most people know this?
No.
I would guess no too, but I was like, maybe I'm in the minority. I know some of the things you're talking about. I'm like, yes, this resonates. I understand this. But then it's like you put it together very clearly. And I feel like a lot of times people don't actually think about it with logistics.
So I think that's the issue with Web3 and in particular with new crypto launches is that for whatever reason, I think founders have been psyoped into believing that they need to become subject matter experts with all aspects of capital markets. But in TradFi, if you're the founder or C-suite of a company that's contemplating going public, you're not expected to navigate that independently. You work with an investment bank, you work with an underwriter that knows that process. You're a subject matter expert of your particular niche. You build product, you build technology, whatever. But you don't have to be the subject matter expert of capital markets. But in crypto, founders are expected to know how to navigate intelligent tokenomics design, market maker engagements, exchange listings. And those are all part of the capital market stack.
Right.
They're really, really nuanced. There's a playbook for success. A founder only has to do that once, assuming they're long-term aligned with the project. But a company like Forge has done this hundreds and hundreds of times and mines massive amounts of data from even launches that we haven't directly supported so that we can have kind of this quantitative blueprint for what you should do and what you should not do in order to optimize your chances at success.
So you're helping them.
Yeah. And I've seen the other side of the coin because I was the CEO of a centralized exchange and the head of trading at a prominent market making firm. And so I know all of the tricks of the trade from the other side. And now I'm kind of giving them back to the blockchain founder to optimize their chances of success.
You bring up market makers. I feel like that is a specific area that people always like to talk about, but they don't really fully understand. Given that you were on that side of things and you know kind of those trades and secrets, can you, one, define what a market maker is, and then two, what really do they play within the broader crypto markets? What's the role, both pros and cons?
Sure. Yeah. For the avoidance of doubt, I don't view market makers as villains. I see them as filling
They're purposeful.
An essential liquidity vacuum. What is a market maker? In its simplest form, a market maker is usually an institution that is a willing patient buyer and a willing patient seller for a particular asset at all times. So that's called providing two-sided liquidity. The consequence of that liquidity and their willingness to provide it allows other more aggressive or impatient traders to trade what they want when they want at fair and efficient costs. Market makers don't do what they do out of altruism. They provide liquidity because they intend to profit.
Right.
They can profit from capturing the bid-ask spread, which is simultaneously buying low and selling high. if it's a CLOB-based order book structure, or through yield farming. That's distribution of fees if it's an automated market making protocol. But really for, traditional market making, we call it intra-order book liquidity arbitrage. Right. But key takeaway is that market makers do what they do because they're profit motivated. They're not altruists. Market makers, as they relate to new token issuers, blockchain projects, are a different flavor of liquidity provision. Right? The reality is for a newly issued token, it's not profitable for someone to deploy their own capital and provide two-sided liquidity. It's difficult to approximate fair value. There's usually not enough volume to generate meaningful revenue from capturing the bid-ask spread. And you might get run over because you've mispriced an asset. So this new niche within the industry emerged, which is like market making as a service for a blockchain project. There's two types of engagements.
Yeah.
First is a retainer and working capital. The second is called loan plus call option.
Okay.
Retainer and working capital, basically you, the blockchain project, will give the market maker tokens and stablecoins. You say, use these to provide two-sided liquidity. Stablecoins are going to be used to place willing patient buy orders. Tokens are going to be used to place willing patient sell orders. I'm going to pay you a monthly fee, and you're going to just make sure that there's liquidity at all times to ensure a positive user experience, right? Pretty straightforward. Loan plus call option. You don't have to pay a fee. You don't have to give them stable coins. You give them a loan of tokens, and that loan of tokens grants them the option, but not obligation, to repay that loan at some point in the future in stable coins, sometimes referred to as like purchase those tokens at a predetermined price called a strike price. In exchange for that arrangement, the market maker will agree to provide liquidity in contractually designated terms. So a certain amount of depth, a certain tightness of spreads. There's trade-offs associated with each type of engagement. The loan plus call option is the most prevalent, and most founders will flock to it just because they see it as essentially a free engagement, right? What do they have no shortage?
Get it back, essentially, yeah.
What do they have no shortage of? Tokens. So they're willing to loan those out, and they see, well, if the market maker chooses to repay this loan in stablecoins, essentially like I've sold them, so it's a form of treasury management. There's a lot of nuance under the hood as to what can go wrong for those sorts of engagements.
I'm sure things have gone wrong.
I would estimate about 70% of all tokens
70%
are victim to what I call the predatory and parasitic market making engagement.
Wow. 70%.
Yeah.
And yet they keep falling for it.
Well, again, I think it's an unfair playing field because it's very nuanced aspects of capital markets and market microstructure to understand why a market maker might be willing to engage in that sort of arrangement with a project. And then nuanced aspects of these engagements that could potentially impact token price post TGE. Founders just aren't privy to it. They only get one shot at this, whereas market makers do this for a living.
Yeah.
And so to navigate at the same level as a market maker is very difficult for a lot of these blockchain founders.
Okay, so like with the market makers, right, you bring up like a good point about kind of the role they play. And I refer to it probably as pros and cons, and like there's positive sides to it, right? And also negatives. But then for Forge, you guys work with both sides, right? So how does that relationship work when you're like balancing, the market makers, but then also the people who are hiring them, I would imagine?
Yeah.
Right? Yeah.
Yeah. So it's a great question. So we have a designated platform for market makers. They're all fully integrated and they get access to new deal flow projects that conduct a request for quote. On the other side, we have projects that want to engage with market makers and track their performance. And all of this is entirely free to use. We've got hundreds of projects that actually utilize this stuff. I think the balance is achieved because ultimately projects want to make sure that they're getting the best deal possible and they're put in a position to succeed, right? And that's nuanced aspects of like getting them the right terms and aligning them with good market makers. Market makers, on the other hand, I think what they've found recently is that the industry is getting hyper competitive, and so their margins are getting squeezed, and a lot of new entrants overpromise and underdeliver. And so the good market makers want to align with projects and still be able to make some money, but they're willing to stand by their contractual promises and obligations. And how do I merge those two or marry the two? It all starts with transparency. Basically, Forge started out offering the ability for projects to track their market makers' performance for free. We have hundreds of projects that do that. That allowed us to put together a market maker leaderboard. We tell you who the best market makers are.
Who are the best market makers? Do you have a few?
Yeah, it varies.
Sure.
Just based on recent trade activity. I think I checked this morning, and like top 3 are Top Hash Digital, Amber Group, GSR is up there, Selene, Oros.
Yeah.
This is based on integrations of about 30 market makers that are aligned with Forge right now. There are still some big players that aren't yet fully integrated, but we just take a very data-driven approach. We've got over 500 project engagements that we track for market makers, and we measure things like depth, volume, tightness of spreads, their loan utilization, so turnover on capital as it relates to depth, volume, KPI adherence, and we sort of aggregate all of those KPIs under the hood, and we say who's the best based on different weightings. So I really think it's the first comprehensive view of like who are the best service providers. The market makers that are integrated with the platform love that leaderboard, right? Because I think most of them like to boast their performance.
They want to be at the top, of course.
Exactly.
Yeah.
And it's always struck me as odd, like for exchanges, everyone knows like who the best exchanges are, right?
Sure.
So like, okay, Binance, OKX, Coinbase, and then you've got like your Bybits, your BitGets, KuCoin, Gate, MEXC, Upbit, like all that gambit. But like you ask anyone who the best market maker
Start
is.
asking, I really don't know. I know some of the names, but you don't have it, right?
And I think like you ask 10 different people, you're going to get 10 different responses.
Yeah.
But usually it's like anecdotal and gut instinct. Like, oh, I heard this market maker didn't do a good job for this project. And like, well, can you really say that? Like maybe you heard horror stories, but again, we kind of come back to this idea that like most founders don't really understand the nuances of market microstructure.
Yeah.
So it's like, where did your market maker fall short on your expectations? Again, there are definitely instances where market makers turn predatory and parasitic, but unfortunately, I think it's because they were empowered by the engagement structure that project, kind of unbeknownst to them, negotiated.
Yeah.
So there needs to be an intermediary, a sophisticated intermediary like a Forge to help projects navigate that process more effectively. At the same time, I think that market makers stand to benefit from an institution like Forge that's bringing more transparency and real KPIs to the table when we say like, these are the best market makers, right? They don't have to promise as much, or maybe they can afford to squeeze a little bit more margin out of this engagement just because they've shown time and time again that they're the best for the job.
Yeah. Do you find that since launching Forge, though, that things have gotten better because of kind of that transparency and relationship that you're building in the middle?
Yes.
I would hope so, right?
Yeah. I think so. I mean, there are over 1,000 projects that use our free-to-use software. There are over 500 projects that use our software for tracking market maker performance. We're aligned with all the major exchanges. And yeah, I think it's refreshing when I speak with a blockchain founder that we say, like, look, if you're looking to work with a team of subject matter experts, we can do that. There's a commercial aspect for our advisory services, like True Investment Bank. But also, if you don't want to pay, like we've built self-service software that you can just do it all yourself. And in that way, it's like my original goal was to kind of make advisors obsolete just with free to use tech that we're now augmenting with AI from an internal closed source LLM. And it's really, really refreshing just because it's like there's something for everyone.
Yes.
Not willing to pay the fee? Cool. Just use the tech to design your tokenomics, or do an RFQ, or automate your exchange listing application, right? Built it for a reason. We want to mine your data and then use it to better inform future advisory decisions. But projects stand to benefit massively.
Yeah, I was going to ask like why it's free, but I guess that explains it, right?
I'm not an altruist, right? I just want to mine massive amounts of private, off-chain proprietary data so that I can synthesize it and use it to inform this data-driven playbook for success.
Okay. Right. And who are you informing with it then?
Our advisory practice.
Oh, right. Okay.
Right? ultimately the end goal for Forged is that we want every serious token launch to interact with our platform one way or another. That's either by working directly with our advisory service or using our self-service tools, or what we found recently is other advisory firms are starting to use our tech for their portfolio companies. Which again, we're giving away for free.
Yeah.
And in that way, we sort of see ourselves as a two-sided marketplace. You've got the projects over here, you have essential service providers over here, and we're sort of this tech that lays between them that helps them navigate the go-to-market process. And when it's time to engage a market maker or list on an exchange or work with VCs to secure primary market or secondary market investments, they can do so from one clean interface.
So given that a lot of this is free, what's kind of stopping the industry from having like this set standard then?
Yeah. I think that's become like a new meta in this cycle. You know, people talk about like transparency scorecards. And my opinion is that projects aren't willing to inconvenience themselves to provide additional transparency to the investing public unless there's something for them to benefit from, right? And unfortunately, time and time again, we've seen like a lack of transparency can pay off. Sometimes it's more advantageous for a project to, I guess, hide in the shadows.
Yes.
And so my approach is that you can use our free tools, extract a ton of value from them, but eventually there's going to be mandated disclosures associated with that. For example, right now, you can use our tools to design all aspects of tokenomics, and you can publish a light paper for free from forge.com. Eventually, I want to mandate that publication. Right? Right now, you could do a market maker request for quote and start tracking that market maker's performance entirely free. Eventually, I want to mandate that there are quarterly reports from that market maker's trade activity or disclosures based on who the market makers are that you align with and high level nuances of that engagement structure. You can use Forge to apply to exchanges and get insights on trading or fees to list on the exchange. Eventually, we want to mandate that those fees that you pay are disclosed to the investing public. And your responses to their questions are also disclosed to the investing public. So we give value, but then we ask something in return and provide benefit to the community. That's also a branding opportunity for us, right? Launches powered by Forge Transparency. And then word of mouth brings us more clients, some of which will use our free tech. If they use our free tech, we mine their data. Others will want to align with us as an advisor. And if we align as an advisor, then we have commercial upside associated with that.
For the ones that have to provide this information, or you're saying like long term, that would be the ideal outcome. What would kind of stop? I think the good players would be like, yeah, of course, like we want to contribute to more transparency, better data information out there. But then some might, you know, the ones that don't want to show that stuff will be like, absolutely not. We're not sharing that with you. And then there's probably people in the middle ground who might want to keep the privacy of that, right? So what do you say to the ones who kind of show some aversion to this?
Yeah, I think that's fine. Again, different strokes for different folks. And that's why I'm saying is that like you want to use my free tech, which is the best in the business, in order to navigate go-to-market more effectively. Eventually, you'll have to make these disclosures.
I see.
And the vision then becomes that since that is an industry norm, those that don't want to make the disclosures are outliers. It kind of begs to question, like, if someone doesn't want to make these disclosures, what do they have to hide? Right.
Well, yeah, that's what I'm saying, like the bad side. And then maybe there's middle ground people who are just like weird about it. I don't know. I'm giving the benefit of
Yeah.
Yeah.
And again, I think we're already starting to see that like with our market maker leaderboard.
Yes.
That like we have integrations with pretty much every major market maker. And these market makers are more than happy to make disclosures because we're anonymizing the projects that they're working with. We're just aggregating on a per market maker basis and saying like who's the best based on different KPIs. We'd never reveal confidential information.
Yeah.
And so now for net new market makers that I speak with, they're kind of at a disadvantage because it's like, where are you on the Forged leaderboard? Well, you're not integrated yet. You should probably expedite that process and start sharing data with us.
Yeah.
Otherwise, prospective clients are going to want to know how you rank to others.
Yeah.
I'm more than happy to share their data. So sort of peer pressure to drive towards transparency.
So you get a lot of angry emails from people low on the ranks.
I have lots of productive conversations about
That's
how
a polite way to put it.
Yeah.
Yeah. Okay. What's the ideal outcome then in the change of behavior for both founders and market makers and everyone that is like using Forge platform, and then, you know, people in crypto in general, kind of going full circle in the conversation?
Yeah. I mean, I want to empower, and I think we are already empowering blockchain founders to make more informed, data-driven decisions.
Mm-hmm.
I believe that strong fundamental projects will win out long term. There's so many nuances to launching a token, many of which relate to the capital markets stack. And again, my motivation for building Forged is out of frustration. I've seen too many fundamentally strong projects fail because they don't know how the game is played.
Yeah.
And so that vision, that end goal is founders make data-driven decisions, whether working with us as an advisory firm or utilizing our free-to-use technology. The vision for the industry and how the industry, you know, continues to mature and improve is increased transparency, right?
Mm-hmm.
Want to bring sunlight to an otherwise dark and somewhat shady industry, because I think that that is kind of the biggest blocker to widespread institutional adoption, right? Institutions, retail can't make informed investing decisions unless they understand the full picture. And off-grid arrangements that are made in the dark, I think, still have such significant influence on the success or lack thereof of new launches. So we're doing those prospective investors a disservice by not providing transparency.
Okay, makes sense. And then how would you kind of define success long term? Or what does it take to even get to that point? Like, what's the timeline for like the dream role for you and your company in this industry?
Yeah, it's a good question. I mean, really, we want to own the full capital market stack. And I think we're well on our way there with tokenomics design, market maker engagements and transparency, integrations with exchanges, and then launch underwriting. I think we'll pursue partnerships with like public sale and launchpad platforms. And having operated as a CEO of an exchange, I have no desire to start an exchange myself. So integrations directly with those service providers.
Yeah.
So again, I think it's just like putting our heads down and keep doing what we're doing. Our more recent pursuits are we've just hired up a quantitative development and research team that basically is expanding our sample size even beyond the Forge platform of just like recent launch performance insights on our tokenomics, just so we can better refine that quantitatively driven playbook for success. And again, just helping as many projects as possible. I think that as tech continues to improve, we may find a future where like advisors are made obsolete, where access to this tech plus AI insights from this massive data set that we have are more than sufficient to support net new launches and power them with data-driven insights. But just more partnerships with good actors, whether that's market makers, exchanges, VCs that want to better their portfolios, than working intimately with vendors.
So if you're one of those listening in, reach out. Last thing, Shane, I always like to ask people to leave us with a piece of advice, something that you've carried with you throughout your now like 10-year time in this space.
Geez, that's tough.
I know.
I had a mentor, an early mentor, that told me, Mark Twain in a letter to a friend once wrote, I didn't have a lot of time, so I wrote you a long letter. And I tell that to all of my employees. Basically, you know, it doesn't take much to just like go on a rambling diatribe, but it takes a lot of thought and effort to be succinct, articulate, concise. And I think there's a ton of noise in crypto. And I found like a lot of people talk past each other, be very, very verbose and like they can have tunnel vision to like what they are building. And I think like more active dialogue amongst companies that are complementary and synergistic, but be very deliberate in doing business. Like everyone's time is valuable. So again, that idea of like, I didn't have a lot of time, so I wrote you a long letter.
Yeah.
Taking that and bringing it to more like business acumen and interaction with potentially complementary companies that I think should be partnering together. So I guess that's my somewhat cliche advice.
Love it. Very thoughtful. Awesome. Shane, thank you so much for coming on today.
Of course. Thanks for having me.